Good evening, everybody. How has your week been? Yes, exciting times are happening, all sorts of things going on. And tonight I've got Brandon, who's going to show and tell and teach us a little bit about his journey with trading and his experience. And he, just a disclosure, he is not phase registered, or this is something he enjoys doing and loves doing. And yeah, welcome, Brandon. I'm just gonna. There we go. Hello.
Thanks, Ruth. I mean, I've been on one or two sessions of these before, but it's nice to be back on YouTube for a change and talking something different to COVID. I mean, it's just it's taken over our lives, right? And we've kind of forgotten what else is happening out there in the world and continues to happen and will continue with or without COVID.
Right.
So
Yes.
yeah, I mean, this has been in planning for a long time. I've been wanting to do a show like this, but you folks have got it padded down. So I thought, okay, well, let me jump on what you've already built as a platform and maybe just share a little bit of my experience. Maybe it becomes a bit of a series, and folks can learn from at least my experience and what I've been able to learn and share in my journey with trading.
No, definitely. Like when you said let's when we had our very first discussion about this, I was like, oh, I know nothing about trading. Like, yes, I know I've got I think a retirement policy, and I've dabbled in this and I've dabbled in that, but I don't know anything. I mean, I couldn't remember what a bear and bull market were, which is I think what we're going to discuss today.
I don't think a lot of people actually do know. I mean, it's a weird thing, right? I mean, you see these discussions sometimes on the news, or if they do like the financial news section, you kind of go like, tune out, and like I've got no idea what they're talking about, right? And the people that present that seem extremely excited or disappointed, whatever it might be, and you hear these terms, but you've got no idea actually what it means. And most people trust the sort of fund manager, or they get a call from somebody saying, well, have you thought about a retirement annuity, or have you thought about this? And you see them once a year possibly, and you know that, okay, I've got some money stashed away for the day that I retire. And typically never actually dive into what does any of these things mean. A lot of these fund management contracts that they kind of set up, which they sell to you within a matter of an hour, has got pages and pages of terms and conditions, which, quite frankly, I know me personally, in the heat of the moment, it sounds great. You're thinking 20 years down the line, they're talking millions, but you never really go through what those T's and C's really mean. And you've got no idea when you sign up what actually happens on the back end. And that's, I think, how most people really approach it, unless you are in the financial sort of sector or get exposure to these things. And, something quite as basic as what is a bull and a bear market, most folks have got no idea. They hear these terms, either get them confused, and they don't even understand what that at the most basic level means. So I think just in terms of this specific stream, it's a bit of a start just to get back to fundamentals of trading, investment. Certainly, we're not going to cover any news or what are our thoughts around a specific stock price. It's really going to be around just understanding the fundamentals of trading or investment, and some of the basic terms used. And hopefully we can start building up a bit of a language that we can have a dialogue on over a period of time. And folks will start picking up a lot more when they hear these things on radio or see on TV.
Okay, no, great. Yeah. I see there some people have joined us. So welcome, Farinessa, Melissa, Lynn, Bazzy's Roadrunner. And yeah, welcome. So let's
Good
crack
stuff.
on. Yeah.
Okay. So I mean, you said you don't really know what a bull or a bear market is, or maybe you've been told what it is before. So your understanding of it, maybe give me a bit of a view of that.
So, like, I sort of skimmed through it today, and I've heard the terms, obviously, and we've all got that picture, that image of the bull outside on Wall Street. I don't know if you've ever watched movies about Wall Street. There's
Yeah.
that big bull on Wall Street. So what I know is a bull is a market that is aggressive and rising and is productive, and the bear market is kind of where we are now, I think, worldwide. Low, yeah, not very productive, high interest rates. But yeah, okay, take it
Okay.
away.
So I'll give you, maybe let's go back a step. So my entry into investment and trading and all of these things, funnily enough, and I'm not going to push crypto here, but it was my first step into investment, right? And it was about 2014. I had absolutely no idea of any of these terms, bull, bear market, or any of that. I took a couple of 100 Rand, put it into Bitcoin at the time. Funnily enough, I mean, it was at the time $350. It's like $50,000 right now. I had no idea what I was playing with, but I just tried to get an idea of what is trading all about. Now, a bull or a bear market, typically, and in any market, in the way that you see it, if you look at it, you know, they sometimes show these graphs on TV to show, you know, price movement up or down. And in any type of trading, there is a buyer and there's a seller. So at, you know, if you've got you have to decide between the buyer and the seller whether you are the buyer or the seller. So either you hold a stock or you want to get into the stock. If you hold the stock, you want to sell it, and if you want to get into the stock, you want to buy it. And between those two parties, they have to agree on a price that makes sense for both parties to either sell the stock or buy the stock. Yeah, sure.
Sorry, just to interrupt you there. A stock would be what? Share, like,
it could be anything, any asset class, right?
Yes.
So, I mean, if I use the most basic example, the same thing happens in terms of selling property or buying property. You decide with somebody who's selling their asset class what you believe is a fair price for that specific asset. So this could be across any asset class. It could be for gold. It could be for Bitcoin. It could be for any, yeah, exactly, any, or company, equity in a company, right?
Cecil.
The point is that there's always going to be a buyer and a seller. So in any trade, in a single trade, there's going to be a buyer and a seller, and they have to agree what that price might be. Now, if there is more buyers towards a certain fundamental or a stock, what happens is that price starts rising if there's not enough sellers for it, right? So maybe there's a reason for that. Maybe the value or the expected value of that stock starts increasing because they've got new product releases, or they are embarking on a new transformation journey, or whatever it might be. If you're in the stock, you might want to be holding it, right? You're holding that stock. If you're not in the stock, you might want to be buying it. So you want to have a position on that stock, and that's how you get into that trade. And so the movements that you see on those charts is how the market is reacting to buyers and sellers. So the more buyers there is, the higher that keeps on climbing, okay? And the more sellers there is, the more that starts dropping, right? Now, if you are bullish on something, that climbs, right? So if you're bullish on a stock, or you're bullish on the price, and the price keeps on climbing for that, there's more demand for it, that is bullish. If there is no demand for it, people are trying to offload their stock, it starts dropping. And that is so the difference between bullish and bearish. And what you've got to take into consideration with either one of these two things is what the time frame is, right? An investor might say, well, I am a long-term investor, so I don't want to day trade. I want to put my money into something, a stock, property, commodities, whatever it is, and I don't want to look at it for the next 5 years. I expect in 5 years' time, it may do 5x, which is 5 times the price of what I bought it for, right? So I don't want to trade. I just want to get in, I want to invest, put it away, and 5 years later, I'll see what the price is. Right? Or the difference, I see Nick is saying, are you taking notes?
Yes.
The difference could be that you're a day trader, and the timeline is important too, because it can go right down to folks that what they call scalp is literally on minute-to-minute movements. Right?
Sure.
So if you're looking at any one of those charts that they show on TV, or any of the charts that you see, stock charts, it is all dependent on a time frame, and it could be over a monthly period, it could be over a weekly period, it could be over a daily period. It could be down to the minute. And these folks that could trade on the minute for every single move that happens, they could be trading up or down, up or down, up or down, up or down, right? So it's always important when you're talking trading to understand, is this person an investor and what they like to refer to in the crypto market as a holder, or is this person actually day trading? Now, some folks say day trading is like gambling. Right? Nobody really knows where the stock's going to go. It is true to an extent. Okay, nobody truly knows where the stock's going to go. But there are some fundamentals which will inform decisions that you make when you're investing into any particular stock or commodity or any asset class. If you know, for instance, that let's use COVID. Okay, COVID again. Yeah, we're back at COVID, but
no,
right?
you're something else.
You are holding large positions on a number of stocks. You realize suddenly if lockdown gets announced, right?
Okay.
For across the world, if lockdowns get announced, there's not going to be trading in retail. There's not going to be international shipping.
Exports.
Flights are down. So let's use maybe airlines as an example, or travel. Maybe you owned a lot of travel stocks, right?
Okay.
And they announce a ban on travel across the world. What you want to be doing at that point in time is getting completely out of those stocks, right? Because the value of them are going to decrease. There's no demand for travel, right?
Okay.
Companies are going to go bankrupt, etc. Sure.
I've got another. Let's look at what happened on Tuesday night. Or was it Monday night? Facebook.
Yeah.
Facebook, yes. WhatsApp, that platform went down.
Perfect example, yeah.
Okay, so let's use that as an example.
Okay, so the two terms that you need to together with, okay, so you know what bullish now is, and you know what bearish is, right? A bull or a bear. Okay, so if I am bullish, if I say I'm bullish, you hear the market or commentators say that they're bullish, it means they're expecting stock to rise. And if you're bearish, it means you're expecting stock to drop. The two terms that go together with that is you either longing or shorting a stock. Right. Now, the big mistake most folks do when they're getting into this for the first time, or they're getting into trading, is they think that the only way you can make money is if the stock price actually increases. This is like the most basic fundamental that everybody misses.
True.
People think the only time you can make money trading in the stock market or any asset class is if the value increases of a stock. That's only one position. Because remember, for every buyer, there's got to be a seller. Right?
Yes,
okay.
Of course.
So,
right, because there are only a set number of shares or stocks.
There is only a set number of shares or stocks. So together with bullish and bearish, there is two terms that go with it. It means longing or shorting a stock. If I'm longing, it means I buy the stock. I'm buying a stock with the expectation to sell it later. If I'm shorting, what I'm actually doing is I am making a commitment to buy the stock at a lower price. So I'll, to a lender, essentially, I'll say, I'll buy the stock. If the stock price goes down to a certain level, I'll buy that from you at this price. So in the Facebook example, if you knew that that was going to happen, what you wanted to do is to short the stock immediately, as close to possible when you got the news that this is happening. Yeah. That would have seen the stock market or the stock price of Facebook crash, and you could have profited off that crash in Facebook for the period until it started stabilizing. Does that make sense, right? So even if I didn't have a position in Facebook, let's say I didn't own any Facebook stock, right? At the moment that I realized, if I got a rumor that there's something happening with Facebook or WhatsApp, whatever it is, the first news kind of article is I would have gone and opened a short on Facebook. That meant I would say, at the price that Facebook is at, I'm going to sell Facebook shares, and I will buy it back at a lower price. The delta between
a fixed commitment. Do you have to do that?
It is a fixed commitment. Well, it's not a fixed commitment. It can roll over as long as you can fund it, and we'll get to that at a later stage.
Okay.
But what I'm saying is, right, if you heard the news that this is going to happen quick enough, and you opened a short, that trend that Facebook went down, you could have profited off every percentage point that it actually went down. So if it went down 5%, you could have made 5% profit on selling Facebook stocks at the time that this news broke until the time that you exit your trade. I don't know if I'm getting too technical at this point in time yet, but
no, but that's like a sum. That's just how it works.
It is.
That's the equation.
The main point here to take away is you can make money regardless of whether the stock goes up or goes down. It only depends on your opening position at any point in time in the stock market. So if you load up 100 stocks or 10 stocks, whatever it is, doesn't matter where they are at this point in time. You can take a position, you can open a position and get into a position to either expect it to go up or go down, right? And make profit on if the market moves in your favor. If it goes up, so if you longed at the bottom and it goes up, you're bullish on it, you make profit as long as it keeps on going up. If you're short on a stock, you're bearish, you open a position at the top and you make profit as it goes down. So there's always one of two positions you can take on any stock regardless of the price.
Is it like playing the roulette table, like either choosing red or choosing black?
It's kind of like that, but with a little bit more informed thinking.
In
terms of, because I mentioned gambling right at the start, right?
Yeah.
So roulette, you don't know. Roulette, you say, okay, let's use red and black as your example. And you say, well, I'm just going to put everything on red or put everything on black, right? And on a 50-50 chance, if you flip a coin enough times, it's 50-50. That's pretty much what it is. You could probably make some money at some times and you'll lose some money at some times. But you've got no fundamental backing data that's actually driving your decision. Maybe some gamblers might believe that they do, but I don't think it's an accurate way of thinking about it. Okay, yeah. Whereas news drives stocks, right? Fundamental analysis drives stocks. And if I say stocks, I'm talking about any asset class. So if you talk about fundamental analysis, it says, do I trust the CEO of this company? Do I trust the ethos that they stand for? Do they have, development life cycles for their products that continuously they're innovating on something, right? Am I expecting a big release in the next year? Maybe I'm looking at Apple. Maybe Apple's bringing out a new iPhone. I've heard rumors of this. It's going to be a game changer, right?
Okay,
on that basis, I'm using a pure example. On that basis, it's informing my decision, right? Of whether I should be getting a little bit more into Apple or whether maybe, let's use a random example, Nokia is coming out with, or they're looking to, Nokia is looking to acquire, this is a really bad example because Nokia's dead.
Cars.
As an example.
Electric cars.
And what they're going to be doing if they do that with electric cars is they're going to bring out the longest battery-driven electric vehicle that you can buy. I want to be getting into that stock. I want to be long. I feel bullish about it. So suddenly I want to get into Nokia because there's an acquisition happening. There's fundamentals that's driving all of the above.
Yeah.
It's far better than just doing a roulette table and going, I'm going to put my money on red and then hope that spinning the wheel is going to do something. That's fundamental analysis, right? The second part is that you get technical analysis. So parking fundamental analysis aside, you get technical analysis. Now, technical analysis is, let's take a look at the actual trading data that people do, right? And you're taking a historical view of this asset class, and you are comparing it against what may potentially happen in the future. There's certain patterns that may repeat. There's certain volumes that keep on happening in terms of buying and selling, purchasing power. Maybe if it's completely stagnant, if you look at the housing market, right, you can draw it out on a graph, and you can say, well, in between 2001 and 2008, there was a huge boom. It was very bullish. People were buying, they were building on their houses, selling, they were flipping profits at like 100% of what they bought the property for, right? You can look at that on a graph and you can see what the activity is. How many people were buying and selling houses? What was the demand all the time for houses at that point in time? We had a booming kind of society that was, or upcoming society that was buying their first homes. Loans were being approved. That's bullish.
Interest rates were down.
Interest rates were down. Everything was playing in its favor. It's technical. You're looking at the technical data that informs your decisions about what may possibly be happening going forward, right? And all of this is in literally in a graph or a technical form that you could look at. And if you look at it long enough, you can start seeing patterns. You can see it over a month. We can see, and you hear it all the time, right? You listening to the radio and they say, okay, this month Brent crude oil is going to go up. So you hear the petrol price increasing. If you start putting those things together, you can start making a picture technically on what potentially might be happening to the price going forward, forgetting fundamentals and everything else, right? And then you get macro fundamentals, which is taking a very broad view around what is happening either in country or what is happening around the world. COVID's a great example. Industry verticals is a great example. So if you maybe right now, let's say there's a lot of security hacks on organizations, this is what's happening, right? But industry verticals would be maybe more focused around the airline industry, as an example, right? Or mining as an industry. So suddenly there's movements in mining, maybe there's strikes, maybe there's whatever. You kind of get a, yeah?
For the blonde in the room, what is industry verticals?
So industry verticals, what industry do you work in?
Okay, property.
As property. Okay, so we use property as the baseline here for everything, right? So as we said earlier, so if it's property, maybe interest rates are low for lending, right? Maybe banks are giving first-time lenders an opportunity without having to pay 10% deposit on something, or there's like a boom, or something's happening. Maybe there's a lot of development in a specific area, right?
Okay.
There's a demand. There's more demand. It's property, right?
Okay.
So if you brought, so it's property. Here's vehicles to the side. Here's oil and gas. Here is transport. Here is everything else. Property is the vertical down. Right?
Okay.
So you could choose at any one point in time where you want to be playing as an investor or a trader, right? So you go, I only want to focus on property. That's like my thing. But then you got to know the ins and outs of property, right? So you got to understand what's happening in the property market all the time, right? It's impossible for any one trader or investor to have an absolute view across every sector all the time. And this is probably the biggest challenge. And this is where a lot of the fund managers come in and they kind of say, well, we give you a basket of unit trusts or whatever it might be, and we will manage your funds on behalf of you, right? So they diversify, but the problem is that you miss out on, if you're actively involved in this, you're missing out on the real highs and lows, because everything averages itself out over a period of time. It gives you maybe 7 to 10% return per annum if you lucky. Maybe somebody can convince me otherwise. That's a good return, by the way. If you put in R1 million, right, in a fixed deposit account for a year in a South African bank, the best return you're going to get that entire year is around 4 to 7% if you're lucky, depending on who you bank with.
Yeah.
Okay. You can make, off a single trade, you can make 20, 30% in a day if you chose the right stock at the right time. And the only thing there, I think, that I can add is time in the market beats the single trade. So you could sit out and you could wait and you can wait and you can wait and you can wait for months for that one trade, and then you got to take it. Like the Facebook trade, that could have been like a once in a lifetime trade. If you put in R1 million there, for once you could have made 5-6% off one single trade in a day and get your money out. Okay, but there's no guarantees, and there's no guarantees in any case with unit trust. There's no guarantees, right? But this is where trading differs to investment and allowing somebody else to manage your money for you.
Right.
So I'm going to stop there because I've been talking now. We said 30 minutes, and I've been talking.
No, it just goes
and I
like
can carry on, for a much longer time. But
yeah. Okay. So, but next time we'll elaborate on it, and maybe we'll talk about interest charges and what is a good profit. You'll know sort of more about what you want to discuss next time. But I think it's important because people think, 5-7% or 10%, that's not good. Meanwhile, I know dealing with property, like they always talk about, at least a 12% yield, or like anything above 10% yield is very good in the property market, right?
So yes, absolutely, of course. Anything that gives you a 10% return, in my view, it's absolutely a good investment. I won't shy away from it. Nobody can guarantee that, though. And not a single investment company, in as far as I know, can guarantee you a return on anything. And I'm happy to be proven otherwise, right? The problem with property, it is a long-term investment. There's nothing wrong with. In fact, I think my first big investment, if you want to call it a big investment, was in property. I think I bought a property when I was 21. In 18 months, I sold it for double the price. That was a great return, right? But it was a good timing in that specific vertical in the market. I called it lucky. And as you learn, as you start trading, some things I guess might be luck, but you get to learn to minimize risk. You get to diverse, and you get to compound each one of your profits all the time into a rotating sort of portfolio. So, I mean, there's a lot more, and I don't know if that's just set the benchmark, but I just wanted to get, firstly, bullish and bearish. What are the differences between the two? Great. As long as you understand that, and you're going to get perma bulls. Those are folks that are always looking bullish. They're always optimistic. They're always looking for the big drive upwards, right? And you're going to get perma bears. They are always bearish. They're looking for the opportunities where the market's going to crash. They are trying to short the market all the time. And these two forces are constantly fighting with each other for where the market's going. And every one of those candlesticks that you see, it's constantly fighting for that.
I don't know. There's a question from Hardy Dave.
That's a new question, yeah.
But
It
yeah.
has leveled out, Dave.
Mm.
It has leveled out. I took a position on Facebook as the news happened to great glee, and I got out of the position, and it has leveled out. But I think it's only the start of the story. There is a bigger story that's happening in the market right now, which is around the S&P 500, Nasdaq, and they've been teetering on bearish. So it's made no sense. Continues to make no sense. Personally, I'm a perma bear as far as the US stocks markets go at the moment. But we'll see how that progresses.
All right. And yeah, please, everybody, just disclosure. Brandon loves trading. It's his hobby. It's his passion. He is not phase registered. He's not working for a trading company or anything like that. He does it as a hobby. So, yes. But I've learned a lot, even though it's a teeny bit. I feel like, yay, I've gained something. So, thanks a lot for that. Like, really, like, okay, I finally know. And like you said, it's all divided. It, like you mentioned, perma now. So, and you're shorting and longing. It's very cool. No, it's something that I'm that I'm keen
maybe
to learn about.
Next time we do a slightly longer one. But yeah, I think the intention is, folks. I mean, I don't mind sharing information. We can do this as a more regular slot. It's to try and just start at the basics and then move through that, and hopefully, and the big thing I think as the takeaway here is you don't need to be rich to trade. Or invest, or just dip your feet into this. You really don't need to. You can start with a couple of $100 as a basic and just try it out and see how it goes. And a lot of people, they don't want to get into the technicals of the stuff to the extent that I tend to do, right? They want somebody to manage their money, and that's fine. That's fine. But the idea of these sessions are to just give you an idea of what's possible, and enable you, if you're keen on learning more, to be able to start taking control of your own finances and hopefully make a buck out of it at the end of the day. Yeah.
Okay. Well, thank you so much. And yeah, do you want to mention your Telegram group, or that's a bit for the mature trader, I think?
Yeah. As we go along, well, I do run a Telegram group, and certainly I'll share the details as we go along if folks are interested.
Okay, absolutely. Great.
Yeah.
Thank you very much. Cheers, everybody. Have a fantastic Friday.
Thanks,
and
Ruth.
Yeah, a lekker weekend. And yeah. Alrighty. Cheers, peeps. Till next time.
Ciao, ciao. Bye.